Hello everyone, and welcome to this hopefully short video explaining stock options. I mentioned in a previous video that they are one way to invest money and outlined at the time that I would call them pretty high risk, but I didn't really go into any actual detail on what they were or how they work or anything like that. So this is basically just meant to be an introduction to them. To really dig deep takes a lot more time than I have in a 5 or 10 minute video or whatever, but I thought I could at least get a little bit of information out there, and then maybe in a follow-up video I will add more detail on bigger strategies that you can use, things like that, to reduce or increase your risk. So, the basics of options are they're just contracts. They're written, bought, and sold like any other contract, except, of course, in the digital era, they are entirely digital, and you don't necessarily hand type them. You basically just say, I want to sell one, and that often writes them, but from your perspective, it writes them. There are clearinghouses and who knows what else that actually say, oh yes, this particular option contract should exist, written at with these numbers and language. What I'm not getting into that. This is just basically from your perspective as somebody who's interested in options. It is worth noting, again, I'm not a financial advisor, nor am I a professional. So, with that out of the way, carrying on, the general idea is that they apply to 100 shares of an underlying asset, meaning any stock, Microsoft, Intel, Apple, Coca-Cola, any stock. Well, not any stock has options, but any stock has the potential to be something that has options for it. And when you have an option contract, when you buy or sell it or whatever, it will apply to 100 shares of an underlying asset, like I outlined already. And what they really are is the right to buy or sell 100 shares of a stock at a given price. It is not the obligation. So what that means is when these things expire, which I'll get into, you don't have to buy or sell 100 shares of the underlying asset. Again, examples like Coca-Cola, Microsoft, etc. But you can if you want to. You get the choice to, it's called execute your option, if you were the buyer of one. So there are European and American styles. I'm going to focus on American because if you can't tell by the accent, that is where I live. So, but the primary difference between the two is the European style can only be executed on expiration day. So you can only choose to buy or sell 100 shares of the underlying asset when it expires. For the American style options, you can do that at any time after you buy the contract. So all the way up until expiration you can, or at expiration. But the key difference is European is only at expiration, American is any time leading up to expiration. So with options, there are a lot of numbers or ideas that can be pretty confusing if you're just trying to get into these. So the cost is misleading because it is listed as per share. Well, like I just said, these are based upon 100 shares. So you may see the cost to buy a particular option contract in a brokerage as something like 10 cents. Well, that'll actually cost you $10, right? 10 cents times 100. So then the strike price, that is the price of the underlying asset. So you'll have an option that says Coca-Cola $200 or something. I don't even know what Coca-Cola's current price is. I'm totally making up that number. But the option will say Coca-Cola $200, and what that means is the point that your option is interested in, is centered around, is $200 per share, with the underlying asset being Coca-Cola. There's also an expiration date. So it'll be Coca-Cola $200 expiring on June 1st or something. I can check dates here, but it's generally going to be the end of the week. Sometimes you see in the middle of the week or the end of the month or the middle of the month. It depends some on the underlying asset and how much desire there is to have options contracts available to us at particular days. So an example would not be June 1st because that's a Tuesday, at least this year. June 4th would be a Friday, is a much more likely expiration date for something like Coca-Cola. There's also volatility. So, for example, somewhat current events here, the GameStop stock is very volatile, but something like Coca-Cola really is not. So with an option, this will affect your cost or the value, if you happen to own it, of the contract. If it's very volatile, it will cost more to get or be worth more once you have it. There's also theta decay and the Greeks. And the Greeks is basically just a bunch of Greek letters that, like theta, that represent various mathematical concepts behind options. And I am not going to really get into them in this video, but if you want to look into it, you can. Theta decay is one that I do actually believe is very important, and I pay attention to a lot myself, just in terms of concept, at least. These are on a time limit, right? They have an expiration date, like I just said. So theta is the concept, and there's various mathematics behind it that I just won't get into. But it's the concept that as time goes on, if something isn't driving the value of your option up, or it's not in the money, which I'll get into in a moment, it will tend to lose value just over time as you get closer to expiration, because time creates the opportunity for volatility, which drives option values. And again, I'll explain some more of this here in just a little bit, but these are in my opinion, the fundamental components of any option. So there are two kinds. There are many strategies, but there are two fundamental building blocks to any option combination or contract. One is calls. These are the right but not obligation to buy a stock at a particular price. So if you, again, want to bet at Coca-Cola being $200 or more, some more than $200 on a given date, you would buy, I'm assuming it's less than that, you would buy a call contract. And what would happen is you would be purchasing the right to buy at 200. So if the value of Coca-Cola shares goes notably above your strike price, it's called, you will make a profit. So fundamentally, how to do that math in the general sense, I keep using Coca-Cola as an example. You really would have think that I would have bothered to check the value before making this video. But whatever, the example is still valid, right? So taking away the specifics of how valid a Coca-Cola example would be, the core idea you can see in this little drawing I made is that you have to pay a fee to buy this contract, right? Or if you're a seller, you are selling it for money on day one, right? So to make a profit, you don't have to just get above your strike price that you can see, right? You have to get above the strike price plus the cost to buy. And that's why the cost is usually listed per share, because it makes your profit range very obvious. So rather than making you inverse the math and divide the cost by 100 to get to your cost to buy relative to the underlying asset, they just list it that way so that your profit line is clearly visible to you. It is the strike price plus the cost per share to buy that option. And there's under the strike price a whole area where your option will expire worthless. And the exact percentage of options that expire worthless is debatable, and I'll get into that in a little bit. But there's a region under the strike price where your option expires completely worthless. You could, I believe in theory, execute it if you wanted to buy the shares, but there's really no point, right? It's not worth any money. When you executed it, you would lose more money. So the strike price and the strike price plus your cost to buy, which is the profit line, right? Those two create an interesting and usually smaller region where you don't profit from the whole transaction if you execute your contract, but you don't lose everything either. So in this range, it is very common to get a contract executed against you, or not against you, for if you have the money to execute your option, you will want to execute it in that range, but you will still have a net loss on the cost of buying the option and the value of the shares. But it's better than losing everything, right? If you don't execute it, you lose everything, and then that region will turn red, basically, right? There's no value to you if you don't execute it, even though it went above your strike price. So, I know that was pretty quick and a little bit complicated, but the key idea to remember is that there's three regions. One is profit, one is total loss, one is partial loss. Puts are basically the opposite. They're the right but not obligation to sell a stock at a particular price. So you're betting, and this the opposite, right? You're betting that it will go down, and I'll get myself out of the way here. You're betting that it will go down as we head towards the expiration date. If you're the purchaser of a put contract, things get more interesting in some ways if you're the seller. But you're basically betting that the price will go down some amount. And you have the same key points as you had for the calls, right? You have the same regions, red for you lose everything, yellow for partial loss, and green for profit range. At expiration, at least. These can all vary throughout the time gap between when you buy and when it expires, depending upon things like volatility, etc. Right? So that's fundamentally the two kinds of options, calls and puts, and that's just a super stratospheric view of where your losses and profits are. But what's the actual point of these things? The point is that you're trying to leverage the volatility of an underlying asset to make money. You're trying to profit off the movement of 100 shares of a stock, whether it's up or down, in through a smaller buy-in cost than just buying 100 shares, right? If you bought 100 shares and then lent them through the short process, which is a whole other thing, you could profit off the drop in value. If you bought 100 shares and then just sat on them and did nothing, you could profit off the increase in value. So if you have the capital to do these things, that's great. Most people do not. So one way to try and make similar profits is to use options. If you think you know industry better than the general market does. So with any form of leveraging comes increased reward and increased risk. So in this case, your increased reward is for a fairly small amount of money. You can profit off the increase or decrease in 100 shares of a stock. That's a pretty big possible reward. You can go to the moon with that sort of money. There are people who spent $100 or something on a GameStop call and ended up turning that into tens of thousands of dollars. And I don't want to give you the idea that's particularly common. It's a little bit more like going into the casino and pulling a lever on a one-armed bandit, and you happen to get $10,000 back, right? It's not common, and it can look an awful lot like gambling because that's pretty rare. And with this comes increased risk, of course, as well. Meaning that if that stock sits still, if it doesn't move, if the price stays the same, your option is going to expire worthless. It just will, because you're profiting off the change in value. Whether it's increasing or decreasing that you want to happen, it's a profit off a change in value. So if it sits still, if it doesn't get to the point you want it to be at or thought it would be at, you end up losing whatever you put in. It goes to $0. And that is pretty rare if you are just like buying regular shares of something, right? If you're buying 100 shares of Coca-Cola, it's pretty unlikely anytime in the near future that they're going to be worth $0. But if you buy a stock option betting that something will happen to 100 shares of Coca-Cola, then it's far more likely the value of that thing will go to $0, meaning it expires worthless. And there's some debate over how many options expire worthless, because it depends on how you measure it. So you can say something like, well, 75% of options contracts expire worthless. But the reality is that most people get out of those contracts, they'll close their position in them, is how that's usually termed, before it's actually worthless. So who's left holding the bag when it's worthless? All of that stuff is way beyond the scope of this video. But what that effectively means to you is that there's a pretty high chance, no matter how you measure it, that your option will expire worthless. And that, in some ways, is just a consequence of how the options market is priced. So, that, I think, is where I'm going to call this video. And I hope it was more helpful than hurtful in terms of understanding. And someday I'll get into the details, or the more delicate, I think is the word I'll use, strategies that you can use with options to increase your reward, decrease your risk, or how you can use them as a longer investment strategy, things like that. So, I will see you guys in the next one.